Shares wobble as Wall Street futures slip. Dollar remains corporation. Sydney global proportion markets started in haphazard fashion on Monday as gentle U.S. records cautioned downside dangers for this week's June payrolls document, whilst the hubbub over possible recession turned into nevertheless driving a comfort rally in authorities' bonds. The look for safety stored the U.S. greenback close to 20-year highs, even though early action became mild with U.S. markets on holiday. Cash treasuries had been close but futures extended their profits, implying 10-year yields were keeping around 2.88%, having fallen 61 basis points from their June height. MSCI's broadest index of Asia-Pacific shares out of doors Japan become flat, after dropping 1.8% ultimate week. Japan's Nikkei brought 0.6%, while South Korea fell 0.8%. Chinese blue chips edged up 0.3%, although cities in Japanese China tightened COVID-19 curbs on Sunday amid new COVID-19 clusters. EUROSTOXX 50 futures delivered 0.5% and FTSE futures 0.8%. However, each S&P 500 futures and Nasdaq futures eased 0.7%, after steadying only a little on Friday. David J. Costin, an analyst at Goldman Sachs NYSE, GS, cited that each S&P 500 sector bar electricity noticed poor returns within the first half of the 12 months amid extreme volatility. The present-day Indir market has been completely valuation-driven in preference to the end result of decreased profits estimates, he added. However, we expect consensus earnings margin forecasts to fall so that it will cause downward EPS revisions whether or not the financial system falls into recession. Earnings season begins of July 15 and expectations are being marked lower given high costs and softening facts. The Atlanta Federal Reserve's much-watched GDP now forecast has slid to an annualized 2.1% for the second sector, implying the country become already in a technical recession. The payrolls report on Friday is forecast to expose jobs growth slowing to 270,000 in June with average profits slowing a touch to 5.0%. Rates up, then down, yet minutes of the Fed's June coverage meeting on Wednesday are almost certain to sound hawkish given the committee selected to hike quotes via a supersized 75 foundation factors. The marketplace is pricing in round an 85% danger of another hike of 75 basis factors this month and costs at 3.253% by means of year quit. But the marketplace has also moved to charge in an increasingly more competitive fee-reduce profile for the Fed into 2023 and 2024, steady with a growing risk of recession, referred to analysts at NAB. Around 60 bits per second of Fed cuts are now priced in for 2023. In currencies, investor demand for the maximum liquid safe harbor has tended to benefit the U.S. greenback, which is near two-decade highs towards a basket of competition at 105.100. The euro was flat at $1.0429 and no longer far from its current 5-year trough of $1.0349. The European Central Bank is anticipated to elevate interest prices this month for the primary time in a decade, and the euro could get a boost if it makes a decision on a more aggressive half-point move. The Japanese yen additionally attracted some safe haven flows past due last week, dragging the greenback again to 135.23 sen from a 24-year top of 137.01. A excessive dollar and growing hobby costs have not been typed to non-yielding gold, which was pinned at $1,812 an ounce, having hit a 6-month low last week. GOL. Fears of a worldwide monetary downturn also undermined business metals, with copper hitting a 17-month low, having sunk 25% from its March top. Met.L. oil expenses wobbled as traders weighed demand worries against supply constraints. Output regulations in Libya and a planned strike among Norwegian oil and gasoline workers were just the ultra-modern blows to manufacturing. Brent slipped 1 cent to $111.62, whilst U.S. crude eased 10 cents to $108.33 according to Barrel. Reporting with the aid of Wayne Cole, editing via Sam Holmes and Sri Navratnam.